My name's Danny Kelman from the Amazing Brokerage, your number one real estate broker in Dallas. And today I'm here with Solomon Chong from the Mortgage Hub. And what we're discussing is something I think is really, really important because I've helped my clients go through this. I've had to do it myself multiple times, is how to get approved and how to purchase homes when you own your own business. So this is specifically designed for those people who are business owners and also looking to purchase a home within the next few years. So, as you were telling me before we started, Solomon, what's changed recently in this world that's made it more accessible for business owners to purchase homes?
Yeah, short answer would be the rates. These programs have been around for a long time.
Hmm.
I would say 6, 8 years.
Yeah.
Um, but just as of recently, there's been more and more investors that are buying these type of programs,
Okay.
or which increases competition. So the rates have come down significantly for where they used to be before. So in the past, um, you can get like a self-employed or an alternative income program loan, but they will be 2-3% higher than, let's say, a conventional rate.
Okay.
And now they've come down to pretty much the same rate. In some instances, maybe slightly better or
Hmm.
slightly worse, but within a quarter to 0.5%, I would say, of conventional rates.
Okay. So it's
So
coming in 1/4%, 0.5% higher.
higher or sometimes slightly lower.
Okay.
Yeah.
So, and what does that depend on?
I think the main driver there is credit score.
Okay.
If the credit scores are really good, like 740 plus,
Hmm.
you're going to be potentially in a situation, and a down payment, that the rates are going to be maybe even slightly lower than conventional rates.
Okay, and these loans you're talking about, this loan program, this is done off of business income, correct?
Correct. It could be to business, instead of going through tax returns, so the traditional way of doing
Yeah.
it. You're looking at the cash flow of the business through either
Mhm.
bank statements or 1099. But let's take bank statements, for as an example. We're going to be looking at the total amount of deposits over a year or 2 years,
Mhm.
depending on whatever gives you like the best average.
Mhm.
And then they'll take an expense factor
Mhm.
off of that income. That
Mhm.
expense factor can be as low as 10%. So you're
Mhm.
using 90% of your income that you got, the deposit
Okay.
that you got over the year. But the default, the lowest end of that would be 50%. And
Okay.
that's typically significantly more income than
Mhm.
you would derive from a tax return after write-offs.
So basically, me as the business owner, I take my monthly or yearly income and I'm able to use 50% of that on the lower end, up to 90%
90%.
of that in order to get qualified for a loan.
Correct.
And so that, as a business owner, that normally is going to increase my purchasing power.
Oh yeah. I mean, I have not seen a situation where it doesn't.
Okay.
Because there's a lot of things, if you look at, there's specific guidelines when it comes to um, conventional loans.
Mhm.
So you have certain write write-offs that you cannot, well, after the write-offs, there's only certain amount of types of write-offs that you can add back in as income. So
Okay.
you're gonna just lose, a ton of purchasing power
Mhm.
by going the traditional route of
Mhm.
using your tax returns.
And I think that's important because the way it happened for me is I had the decision where I could invest more into my business
Yeah,
or buy a nicer home for my family.
correct.
And I had to make that decision, which was I had to let the business suffer while and pay more in taxes that year, right?
Yeah.
And then purchase based on that for a home for my family. But now with these new programs, that wouldn't be the case, right? I wouldn't have to choose either or. I could do both.
Yeah, you can take advantage of your, the tax laws, right? And being a
Mhm.
self-employed, like a business owner,
Mhm.
being able to invest money in your business and still be able to have the same or more, or sorry, more purchasing power than you would going that
Mhm.
traditional route.
And what sort of businesses can this work with?
I mean, it works for any self-employed business. I mean,
Okay.
I mean, we've done loans for landscaping companies to, attorneys and doctors, so anything in between.
Mhm.
It's, if you're self-employed, whether it's as a sole proprietor or you have a
Mhm.
corporation, um, this program will work for you.
Excellent.
Especially nowadays, right? We have, after COVID, you have a lot of the gig workers, right? The
Hmm.
gig economy,
Yeah,
where
like online workers and
online
things like
workers,
that.
people have their own business. That we're seeing more and more of that,
Hmm.
and you know, y- it's just something where I feel like the industry, or in general, you know, the the economy is going towards,
Hmm.
and this
Yeah, so
allows
if you're a contractor that have 3 or 4 different jobs, you're able to use all of that income
all that
in
income.
order to purchase a home. What about people that are signed up to these big sites like Uber, Lyft? Like, are those 1099s? Would those be included
Yeah,
in this program or?
those will be included as well.
Okay.
Anybody that gets that's a self-employed. So I mean, anytime you're not W-2'd,
Hmm.
you're considered self-employed, right?
Hmm.
And you're getting a 1099,
Hmm.
or you have a corporation and you get your corp income.
Hmm.
You can use these type of programs.
Okay. So any sort of creative artists, um, just trying to think, real estate agents,
Real estate agents.
that's probably a good one.
Well, and that actually brings up a good point, because with you're going to have seasonality in a lot of in some self-employed fields,
Okay,
right?
like real estate agents,
Real
for
estate, for
example. Yeah.
example, you have your high months, your low months, and it's not, you're not going to have to answer for, okay, did your business decline over the last couple of months because you
Mhm.
just didn't have as many deposits?
Yeah.
Well, that's explainable,
Yeah.
right? So these are not going to be roadblocks that you're
Yeah.
going to be dealing with.
And why do you think this has changed within the industry? Why do you think those rates have lowered?
I think whenever you have more competition within any market,
Yeah.
right, then that's going to drive the interest rates lower. For,
Mhm.
and when these programs just came out, it was something new.
Yeah.
So you didn't have as many investors buying these type of loans.
Mhm.
Now these loans have been done for a while. They've performed in the open market, right? There's the default rates aren't higher
Mhm.
than they would normally be in a traditional loan.
Mhm.
So there's more confidence in the product,
Okay.
right? And the more confidence in the product, more investors are coming and buy,
Mhm.
participating in
Mhm.
purchasing these type of mortgages.
So the reason the rates have fallen is basically it's been in the market a while. There's not a massive amount of
Yeah,
default, and then do you think it's also to do with the rise of self-employed people because that's got
yeah,
to have exploded over the?
it has, but also it's just the risk factor, right?
Mhm.
So riskier
Always comes down to
mortgages,
that.
right?
Yeah.
Yeah, riskier mortgages are more expensive.
Yeah.
So in the beginning, it was looked at as these are riskier mortgages, right? Because we're having less income documentation.
Hmm.
But that turns out not to be the case. They're not, the loans aren't less documented less.
Yeah.
It's just a different documentation,
Hmm.
right?
And then the process more strenuous than a normal process? Is it more, are they going to have to provide more documents, or how does the process look,
I mean,
to,
you know this for yourself, right?
yeah.
Like it's
Well,
actually
I don't know if
it's
it's every business, right? Is every
no,
business is
I
the
think it's
same?
definitely going to be less, because whenever tax returns are complicated,
Yeah.
right? And you're going to have certain things on tax returns that are going to have to be explained.
Hmm.
When you're looking at bank statements, right? You're looking at you're looking at the deposits. Maybe you have some large deposits, and you may have to explain those.
Hmm.
So if in your case, for example, a real estate agent, then they had a typical commission check, and then they did a large deal,
Hmm.
right? Expensive home, higher commission.
Yeah.
So that's explainable,
Yeah.
right? So and that's going to be the case for most people, right?
Hmm.
You're going to have certain variances within the income that they receive, so you
Yeah.
might have to explain that.
Yeah. Like restaurant owners are going to have bigger months and.
Exactly, exactly. So, I think to answer your question is going to be less documentation
Yeah.
than a traditional mortgage,
Yeah.
um, and it's also quicker,
Yeah.
right? The underwriting process is going to be a lot quicker
Mhm.
than when you have a full review of the tax returns.
People say mortgages, right? They say rates, this, that, and the other. Hear people talking. For anybody watching this, can you break down exactly how mortgage rates work and what is taken into effect with a?
Well, there's two sides to that in terms of like what influences mortgage rates, as
Yeah,
far as like how do they move up and down. They're
yeah.
going to
How
be,
are they made?
yeah. As far as their mortgage rates go up and down based on the bond market, mortgage-backed securities.
Okay.
Okay. And as opposed to like, contrary belief that people think, okay, the feds are, influencing mortgage rates as far as
Mhm,
when they lower, when the Fed lowers the prime rate, that directly affects mortgage rates. That's not the case.
mhm,
Mortgage rates are affected by the mortgage bond market, which then um, is influenced by economic data,
mhm,
right? Employment reports, inflation reports, et cetera.
mhm,
So as those reports come in, people, the people buying mortgage-backed securities
mhm.
buy more or less of them.
Yep.
The more, so that is going to be that's going to cause the fluctuations in the mortgage rates. Now, as far as how rates are made, as far as to the consumer,
Mhm,
right? Um, if you think about it, every bank, every mortgage lender, every mortgage broker pretty much has access to the same rates
mhm.
generally. What makes the difference between one rate versus the other in terms of what one company offers versus another company
Mm.
is going to be the margins, right?
Okay.
So the
So
higher their
the company
margins,
making less money, basically.
exactly.
Yeah.
So if the more streamlined you keep your
Yeah.
margins, the lower the rate's going to be to the end consumer.
So
Okay.
everybody can get the same rate, but it depends on what margin the individual business or broker's willing to take.
Correct. Like larger companies,
Yeah.
right? You're gonna so to kind of break it down, you're gonna have a company margin usually built into their rate. You're gonna have a branch margin if there's a
Mhm,
branch involved. You're gonna have a loan officer margin,
mhm.
right? So all those are kind of baked in. Those margins are baked into the final rate.
Yep.
So if you think about it, if the company has a lower margin
Yep.
and the branch is a lower margin, and the
Mhm,
LO, the loan officer has a lower margin,
mhm.
you're going to end up having a lower rate, right?
Yes.
So the more streamlined you keep things,
Mhm.
the more structure, like it's streamlined, the flatter, like your management structure, the more
Yep.
efficient you are. Um, you're going to be able to run lower margins and still be profitable, which ultimately is going to give you that lower rate.
So the way you're able to compete with the bigger companies is rather than having 15 people work on something, you have a more streamlined process. They go directly to the source and you're able to beat them based on rates because your margins are lower. Would
Correct.
that be a
We keep
good?
the lower you keep your overhead in generally,
Yeah.
right? Now, can you keep your overhead low and also keep your margins high? Sure, you can.
Yeah.
But then you're going to end up having higher rates. But I think the
Yeah.
big misconception out there is that your Rockets or your Chase or
Yeah. Yeah.
big retail lenders are going to have, because
Mhm.
they're big, they're going to have
Yeah.
lower rates, which is completely the opposite,
Yeah.
right? This typically the smaller, the more independent the company is,
Mhm.
the bigger the focus on streamlining their operations,
Mhm.
the lower they're able to keep those margins while
Mhm.
still be profitable,
Yeah.
right? And that's what we do.
Yeah.
We focus on trying to keep those margins as streamlined as low as possible, so we can give the best rate to the consumer,
Mhm.
which in turn makes us more referable,
Yeah.
right? And we have to spend less money on marketing to be able to put out there,
Mhm.
and try to
Yeah. So
attract
these
customers.
So the way you're able to compete with the big brokerages, right, is they've got advertising budget, they've got investors, they've got salaries, they've got this loan officer, this person, this sales director, all included in this margin,
Exactly.
you know. And so there's a ton of cost there that essentially the end user is paying for, you
Yeah,
know.
yeah. But I think the point to also emphasize there is like the more streamlined operations you have and more efficient you are,
Mhm.
then you're able to not suffer in terms of service
Yep.
and still while giving that lower rate, right?
Yep.
Because I mean, your first thought would be, well, yeah, that's why they have better service because they have so many people. Well, that's
Yep.
also not true,
Yep.
right? So you can kind of find that balance where you're able to be very efficient,
Mhm.
very fast, very service oriented,
Mhm.
while still keeping those margins
That's
low.
probably a good business question for you. Where did you find that balance? Where was the right balance that you found for the mortgage hub works best in service and streamline cost?
Well, I mean, I think it's something that kind of happens when you're growing, right?
Mhm.
You can't just you're a business owner. Like,
Yeah.
let me just hire, X amount of people
Yeah.
because I need to prepare for this influx of business that I'm going to get.
Yep.
No, you're trying to figure out how can you stretch what you have
Mhm.
to be able to meet your needs,
Yep.
right? And that starts small.
Mhm.
And then you're trying to figure out, okay, how can I add more in terms of more input, more customers,
Mhm.
more clients, while keeping my service level high. So you're figuring it out kind of as you go,
Yep.
as far as how to do that,
Yep.
right? And because we're not, backed by a huge investor or a big company that says, "Oh, here has X amount of millions of dollars, hundreds of thousands of dollars, and grow your team." No,
Mhm.
this was we built it grassroots,
Yep.
from the bottom, just like you have.
Yep.
And you really become good at figuring out and working with the assets or the folks you have, the talent that you have currently on staff. And
Yep.
you're only adding people when okay, I've outgrown
Yep.
this. And now my
So you and your team are working harder in order to deliver lower
yes,
rates, is
yes.
basically.
I mean, that's what it comes down to,
Yeah. Yeah.
and but you try to find that balance,
Yeah.
right?
Yeah, which is yeah, normally somewhere between hiring people and making them work as hard as possible, and how much you can take on as well is
Yeah.
we office together, so I always see you working pretty much 24/7, so that as well obviously is taken into account for lowering those costs, right?
Oh yeah, yeah. I mean,
Personal effort,
personal effort,
you know.
yeah. And you see that as far as when you look at these bigger companies, they have a lot of managers, a lot
Mhm.
of people that are helping out, but they're not actually producing,
Yeah.
or doing loans,
Yeah.
right? They're actually not,
Yeah.
adding a lot of value.
So you've trimmed all the fat of it basically and just found
Exactly.
the leverage points.
Yeah.
And when it comes to like doing these loans for business owners, what are some of the challenges that you've seen for them um, previously and now doing these loans, and what those have fixed basically, or these new loans, how they're helping solve those issues?
I think a lot just people just don't understand them yet, even though it's
Yeah.
very simple,
Yeah.
right? I mean, you just did
Yeah.
one
Use
and
business income
use
to get
business
loan.
income, yeah,
Yeah.
it seems okay. Well, what's the catch,
Yeah.
right?
And
Um,
previously there was a catch now, which is
and the
extra
previously
rate.
is like,
Yeah.
yeah, previously it was, yes, it could be, you can qualify, but guess what? You're going to be paying, 2, 3% higher in rate.
Yeah.
Now you don't have to do that. It's almost, you know, talking about it and really kind of explain to people like the simplicity of this
Yeah.
program and that you're not giving up anything.
Yeah.
And that's, I think, one of the main things people just don't understand yet. It's not, yes, it's still it's more popular,
Mm.
but it's still a very small market compared to the
Yeah.
normal conventional loans.
And what are the sort of in relation? I think maybe one of the downsides for some potential business owners would be what are the down payment amounts? Those are slightly higher, correct?
Well, yes, yeah, that's a great point. I mean,
Yep.
you can go as low as 10% down,
Yep.
so you're not going to find, at least not yet, a
Mm.
5% down payment,
Yep.
for this type of program,
Yep.
or a 3% down payment.
So who this is specifically for is the business owner who's got cash saved that's ready to, purchase, but is the other loans aren't making sense because they can't prove income because they've been investing in their business.
Correct, but like for a business owner, typically, I mean, think about your first home you bought.
Yeah.
The same for me you're gonna have to make that decision,
Yeah.
right? Saying, okay, well, do I invest less on my business
Yep.
and and then use that money for down
Mhm.
payment, and
Yep.
also, take so invest less, pay more in taxes, and then lose
Yep.
the cash available for down payment.
Mm.
So
Yep.
you don't have to make that trade-off anymore, because
Yep.
you do typically, for a lot of business owners, they do have the access to capital,
Yep.
but now they're not going to have to put that
Yep.
against
Yes. My
something that's may be disadvantage for them in the long run in the overall picture.
Yeah, my first ever loan, because my wife owns a business also, but she pays herself W-2.
Mm.
So our first ever townhome that we bought years ago is we had to rely heavily on that W-2 for the approval, and then obviously working in real estate, and I had a digital agency at the time as well, that was, basically business income, and I was investing a lot. So with our first ever home, we had to be very, very modest
Yeah.
with selecting that. And then with our second purchase, is after meeting you, we're able to really kind of upgrade quite a bit. But then also we had to plan for that,
Yeah.
and the planning for that was like, okay, I'm gonna have to invest less in my business and basically pay more in tax this year in order for me to get approved for the home that I was looking to do. And then yeah, it's obviously the down
Which is
payments.
intuitive, right, as a business owner, because
Yeah, it's
you
difficult. It's a difficult decision to
yeah,
make,
because now you're spending less on marketing, less on things to actually grow your business.
Yep.
I think just understanding. I mean, so for example, we have if we just talk about the business bank statement program itself, we developed a tool that and, you can access just directly online. It's super easy to use. Takes 5 minutes.
Yep.
You can put on a basically input your deposits over the year or
Hmm.
24 months, as a sum for each month, and
Yep.
then against that you put, okay, which deposits should not count, like, okay, I got a refund for something, I
Yep.
exclude those. And you input those figures, hit calculate, and it gives you, within, like, right there on the spot, what you would be qualified for after applying, like, the expense factor.
Mm.
So just know how easy it is to find out, okay, what do I qualify for
Yep.
as far as income, right?
Yep.
And then you can compare it to your tax return, and it's something you could do yourself, easy online.
Hmm.
There's no credit check or anything available to be or needed to be able to do that.
Hmm.
And then I think once you can see what that difference is,
Yep.
you know,
Yeah, once you
um,
can quickly calculate and you're like, okay, I can. I think for a lot of people, it's gonna be, oh, I can buy a house now.
yeah,
you know,
it's like, well, I mean, because I know roughly,
you
in
know.
my taxes, I make 5 grand a month.
Hmm.
And then you run this, I'm like, oh, okay, wait, I have 15 grand a month available as far as income. It's
Yep.
a huge, I mean, and these are not, I'm not exaggerating about the
Yep.
difference.
Yep.
And we just did one recently, for a business, a business owner. He owns a couple of different restaurants.
Mm-hmm.
I think he qualified at maybe 60 or 70 grand,
Hmm.
through his tax returns.
Yep.
We had $25,000 available a month,
Yep.
through the business bank. I mean, look at that discrepancy between those two numbers.
Yep.
Yeah.
Was that 10 times?
No,
You
no,
said
no,
yearly
no,
or
no, no. This is on a monthly
okay,
basis.
on a monthly? I
Yeah.
thought you said it was 60 a year that was readily
Sorry.
available compared to
No,
25.
it was
Yep.
60 or 70 per year
Hmm.
versus 25 a
Yep.
month. So
Well, the difference it made for me personally is then we didn't have to use my wife's W-2 income anymore on this latest one. So now we have a whole, you know, line of credit readily available for investment properties,
yeah, yeah.
is